Get on board with crypto. Sheesh. Hello, everybody, and welcome to another fantastic episode of Blast Off with Ribs. Yes, I am your host, Ribbit of Freaking Ribs. Today, we're going to get into a whole bunch of stuff, but if you guys haven't checked this out already, it is a working social media network called Red Wave, redwave.com/ridiculousribs. You can find me right there, right now. I am on the platform. Right meow. So, yep, check it out, guys. It is fun, free, and technically it pays you in crypto, in wafer tokens. You can actually get a bunch of tokens for every post that you do. You get about 100 or so. Actually, let me double check that, make sure that is still correct, because they do change things pretty much every day. Nope, still 100 points. To get one, referring people is about 500. My referral link is in the description below. You can also find me on Twitter, BlastOffWRibs. That's me. I'm the only one. Not that people are actually scamming you through my stuff, but just so you know, that's me. This is me. There's only one me. Anyways, let's get into it. So this is a video of the SEC chair, Gary Gensler, discussing potential crypto regulation and stable coins. So I'm just going to play this clip here. It is about 5 minutes long, so bear with me.
You have been adamant that there should be some degree of coordination with the CFTC and you about trying to make it so that we have more clarity, let's say, on cryptocurrency. Where's the state of play crypto right now?
Look, this is a highly speculative asset class. We've known this for a long time. The ups and downs of this speculative asset class, Bitcoin, and hundreds of other tokens. And many of these tokens offer the investing public, or the investing public is hoping for a return. Just like when they invest in other financial assets we call securities. And many of these financial assets, crypto financial assets, have the key attributes of a security. So some of them, they're under the Securities and Exchange Commission. Some, like Bitcoin, and that's the only one, Jim, I'm going to say, because I'm not going to talk about any one of these tokens, but
sure,
my predecessors and others have said they're a commodity. Working together, there's two great market regulators in this country. I have the honor to chair the CFTC, a terrific agency. I have the honor now to chair the Securities and Exchange Commission. A little bit different remits, a little bit different approaches, but working together with the banking regulators as well. There's work to be done there around what's called stable coins. There's a lot of work to be done to really protect the investing public. And many of these tokens right now are trying to operate, they're potentially non-compliant, and I'll leave it at that, Jim.
Okay, well, one of the things that I love about what you've always believed in is transparency. You mentioned stablecoin. I did not bring that up, but there is one that is regarded as being perhaps not as transparent as we'd like, which is called Tether. And it's very big, about 60 billion. If they told us what they were really in, what they had their money in, wouldn't that be better for everybody?
Look, transparency is a key part of the investing formula. It's kind of part of the basic bargain that you get to, on a quarterly basis, know something about the companies, and if material events happen, like they do all the time, and companies make additional filings called 8K filings, and the public gets to decide what risks they want to take. That's the basic bargain. Similar to stable coins, we have something called money market funds. And in money market funds, you get to see what's underneath the hood, what's really below that one-to-one relationship, where in a money market fund, the public has come to understand that, except for in very unusual times, they get $1 for $1. Or at banks as well. Stable coins have similarities to bank deposits, that you have something standing behind that relationship.
Okay, well, one of the things that happened, and I sure hope that that clarity and transparency occur, but one of the things that happened, at least in many of our lives, I've had all my life had my money with Fidelity. And they came out and they said, look, you can put your Bitcoin in 401k. It was a seminal moment because if 401k is made for securities, you put Bitcoin in, and suddenly that kind of endorsement makes us feel very comfortable, Mr. Chairman, with the asset that is Bitcoin. Are we too comfortable?
Look, there's a lot of risk in crypto. There's also risk in the classic securities markets. What we have in the US is we have this concept that you have market regulators like the CFTC and SEC to help protect the public against fraud and manipulation in the markets. And when there's a group of entrepreneurs that are selling something to the public, who are saying to the public, come here, come hither, we've got this great idea, that when you do that, you've got to have basic disclosures, full and fair disclosures. That's what the SEC does. That's what we do really well. It's less so, in the oil markets or the wheat markets that the CFTC has. And so that's what we have. And right now you have hundreds, if not thousands, of these crypto tokens that have the basic attributes of raising money from the public and having a group of entrepreneurs that you might have on your show saying, come hither. We've got a good idea for you. And that's okay in America if you comply with the laws. And we've got, unfortunately, a lot of projects that are non-compliant.
There it is, guys. And this is true. This is true. If you've ever been rug pulled, non-compliant. Because there is no regulation. So a lot of these companies or cryptocurrencies that just kind of come out of thin air on just about any blockchain, whether it's Binance Smart Chain, whether it's Ethereum, whether it's Avalanche, Phantom, any other cryptocurrency that's ever come out on any chain, none of them are regulated. Not a single one of them. Yes, there are the coding audits, but in reality, it's just to make sure that the code works. It's not necessarily to make sure that the code is doing exactly what it's supposed to do, and then also looking at and auditing the people or the developers of the entire thing. So the regulation will help us to regulate all these tokens. I'm not gonna swear anymore. So sorry, guys. All these tokens, they're very unregulated and they're causing a lot of havoc in the crypto market, and they're causing people to leave ultimately, or they're seeking other avenues. We've gotten rug pulled. A lot of people in that community will want to take over the token. They'll want to do this, they'll want to do that. The community thinks they know what they're doing when they're doing stuff. In reality, no one knows what they're doing. Some people do. They do know what they're doing. Tether seems to know sort of what they're doing. They did hold their peg a bit. They are a little bit down, as you can see on the video there, even though the footage looks like it's probably from yesterday. When did this article actually come out? It did come out a couple days ago. So on Monday, this came out. So that makes a little bit of sense that it's a little off from today. But regulation will be good for crypto. In my personal opinion, it will weed out a lot of these tokens that are rug pulls, that eventually become that, whether it's, they missed funding, or there's the crash, now they have no liquidity, or they just decide to up and leave and take all the crypto with them and do whatever else that they wanted to do with it. It will eliminate fraud. It will eliminate a whole lot of different things for us in the crypto markets. So I do believe that regulation will help. It just depends. It might be too strict at first. It could be too lenient at first. But I think too strict is probably what will happen with that, especially with the SEC getting involved now. Sort of. Regulation will be coming. I believe a lot of people have been saying 2023, 2024. I believe that we'll probably get it 2024 to 2025. So we're still in for a little bit of a bumpy ride with that. The markets are still down at the moment. They're still going down. So I believe we're in the 19,000 range at the moment with Bitcoin. So, yeah, I think regulation will be good for us. And let's get into the next little bit here. So the BIS, so the Bank of International Settlements, will allow banks to keep up to 1% of Bitcoin in their reserves. This is bullish news if I've ever heard any. 1% is a good place to start. I believe this should increase over time. With if and when Bitcoin decides to stabilize itself, it's the whole crypto market in general. When the price definitely stabilizes, we'll probably see this number increase due to the volatility. It's pretty hard for banks to get involved, especially with this crash going on. But banks are probably seeing this as an opportunity to be like, why don't we scoop some up now? It could become more than 1% at some point. Like in most cases, for anyone who is an early adopter, Bitcoin has probably been a staple of their investment portfolio, especially if they started buying in 2009. It's definitely a staple. And if they bought anytime before pretty much 2015, it's really 2018, 2017. So if you've purchased Bitcoin before the last 5 years, you're probably doing very well. I unfortunately came in just after everything. Pretty much started buying around 3K, more around 6, and probably more around that 20K, and even into the 40s and 50s. So, yeah, I've been buying a lot. I don't have a whole token. I'll just be transparent about that. I wish, but I have a lot of other tokens. So, but this is good. This is good stuff. Specifically, this chart here is telling us that if these assets, which are tokenized traditional assets and stablecoins, meet the qualified conditions to be one of the asset classes for these banks, the capital treatment will generally be based on existing Basel framework, add on to infrastructure risks, and stablecoins that are narrowly past the basis risk test. So it looks like they're going to be regulating these things a little bit more, especially if banks are going to be getting involved. We could see a little bit of a change with this, and this is honestly very bullish news to me. Very, very bullish. And then if they don't have, it looks like there's two groups here, and if they don't qualify with the conditions, they'll adopt market risk rules netting to 100% capital charge, which meets the hedge recognition criteria of Group 2A, and does not meet the hedge recognition criteria. It looks like they will be doing a little something different there. And there will obviously be an exposure limit for Group 2, especially if they don't meet the classification conditions. I think this will be good, especially since a lot of people, and not only people like retailers, but in institutions have been a little skeptical towards crypto. I mean, can you blame anybody? I guess if you have large sums of money and you're looking for safe bets with the volatility and the high risk, it's very hard to manage risk with such high volatility. Now, if you're just like a DCA or like it's very different. If you're looking long term, it's very different too. Obviously, institutions do look very long term, but it's the short term comings that are really what's going on, and also what is happening in those markets as well. So I think this is very bullish news, the fact that they're going to allow banks to keep up to 1% in Bitcoin. So this is a great first step into this market here, and a great first step for Bitcoin for getting into the banking system in the traditional aspect of it. And we'll hopefully see over time, and as time goes on, things changing and making things very much different for the space. So that's it for me today, guys. Thank you guys for tuning in to Blast Off with Ribs. I hope you learned a whole lot today, and I hope to bring you guys some more stuff. So thank you. Please smash up that like button. Please subscribe to the channel, and I'll bring you some more breaking news soon. Like, comment, and subscribe to the channel.